Hey Puppy Trades, I wanted to do a video analysis update of the stock market. We're going to talk about the S&P 500, the Nasdaq, Microsoft, Alibaba, Amazon, Google, Boeing, American Airlines, Apple, NEO, Fastly, Carnival Cruise Lines, Nike, XLE, the oil stocks, Chevron, and Disney. So let's just get right into it. What was the big argument coming into this week that the stock market wasn't ready to crash? Well, the biggest arguments came from Boeing, American Airlines, Carnival Cruise Lines, Microsoft, and the XLE oil sector ETF. All these stocks we had an early read on. We projected big impulses before they happened, and now we had a lot of evidence that they were still incomplete to the upside. And it didn't really make a lot of sense that Microsoft and Boeing and Carnival Cruise Lines and the oil stocks were going to be taking a big rally higher, but the market was going to be crashing. We also had some consumer stocks like Nike and Walmart and Procter & Gamble that also showed a lot of upside. So what was the argument against the market moving higher? What was the argument against the market moving higher coming into this week? Well, the smart argument for the market moving higher, or the market not being able to move higher coming into this week, was that the CBOE volatility index, the VIX, was too damn low. Okay, so I'm going to give my opinion on the VIX right now. What you have to understand is that if you ask 50 people about the VIX, you're going to get 50 different answers. Okay, you're not going to find anything I'm about to say in a textbook. Okay, do your own research. And obviously, none of this is investment advice in any way. But here's my opinion on the VIX. The first kind of tenet is that shorting volatility is one of the most popular trades for large institutions to make. Okay, so shorting the VIX after it spikes is a very popular trade to make. On the flip side, most of the volatility ETNs like VXX and UVXY are not designed to be long-term investments. You can read the prospectus. It will tell you that they're not designed to be held for an extended period of time. So that's kind of the first tenet. The second tenet is that it's a pretty popular trading strategy for more passive, more savvy, people who have been around the market for a while, that they will specifically wait for the volatility index, the VIX, to spike above 30 to buy stocks, right? And they believe they have their statistics that over a longer period of time, buying stocks when the VIX spikes above 30 will work out for them over time, okay? And we can see exactly where they would get that idea, right? What were the best buying opportunities? Surprise, surprise, they were all these, VIX spikes. So when the VIX reached, 40 in June of last year, that was a huge buy. When it reached 40 again before the election, that was a huge buy. When it reached 37 right before January, that was a huge buy. And so that's where this kind of strategy that some have adopted of just waiting for the VIX to spike above 30 before they buy stocks has kind of come from. So that's not a strategy that I implement. And it's not one that I'm, recommending anyone implement. But it's important to realize, and this kind of leads me to the third tenet, that the volatility index being crushed is really one of the few things that actually drives stock prices. So when the VIX is being crushed, that is providing the fuel and the juice to move higher. So that's why before this week, people were saying, how on earth are we going to go higher if the VIX is below where it was before the March 2020 sell-off, right? And that question has gone away, right? We have had, in just a couple of days, two 20% spikes in the VIX, right? So I think this is the first place to start as far as invalidation levels go. If the VIX stays below 27.41, then bulls have a lot of upside. They've got a lot of stuff to look forward to because this VIX being crushed is going to be fueling a big move in the market higher. Okay, the other tenet is if the VIX breaks back above 27.41, that's probably a really good level to be cautious, right? So this is straight from the CBOE.com. This is where I'm going to get my quote. The VIX is continuing to be below 27.41. That's kind of the first short-term, invalidation level. Let's talk about another invalidation level by looking at SPY. So this is the S&P 500. I think it's important right now for SPY to remember the bigger picture. So this is a large degree wave one. And remember, in my last video, I explained how, a lot of people think wave theory is voodoo, so we can't call this a wave one. We have to call it a bull flag, right? But it's the exact same projection that if you take the length of the first leg of the bull flag, you place it at what we're calling the wave two low, what they're calling the low of the bull flag consolidation, then the conservative target would be the length of the first leg of the bull flag placed at the low. That would take SPY to about 460. It's the exact same projection wave theory would give you, where instead of calling that a wave one and a wave two, you're saying the conservative price target would be the length of wave one placed at the wave two low, taking you on a wave three rally to 460 at the minimum. And I think that's an important thing to keep in mind especially after we've gotten, this big sell-off this week, is that the bigger picture would take SPY to 460. Let's talk about the smaller picture real quick. I'll just get the most conservative projection when we talk about SPY, and then maybe for the Nasdaq and Microsoft, we'll talk about why this might be conservative. So this is a wave 1 and a wave 2. In my last video, I explained how wave 3 either ends right here and wave 4 ends in late January, or wave 3 ends in mid-February and wave 4 ends in early March. So I talked about in my last video, you can go watch it if you want, how whether this is the wave 3 high and this is the wave 1 high, or if we move these numbers over slightly, and then this is wave 3 and this is wave 4, that it was going to give you the exact same projection, because either way, the length of wave 1 placed at the wave 4 low was essentially the exact same number. Okay, so I do believe for this video, we're just going to focus on this count where wave 3 ends in late January and wave 4 also ends in late January, and then we begin a larger degree wave 5. So why is this conservative? Well, remember in my last video, I said that I wanted to see 403 not be broken. So I trade on bar chart. I have the daily candles, and on my trading platforms, I also trade the daily candles. I don't have any daily candles that broke below 403. Okay, you want to be a futures trader, go trade futures. I don't trade futures, so I trade the daily candles on my trading platforms and on bar chart. I don't have a break below 403. So this count of a wave 4 low was never invalidated. So this was wave 1, wave 2, wave 3, wave 4, and then we begin wave 5. So this is wave 1 of wave 5, wave 2 of wave 5, and then this is wave 3 of wave 5. Now wave 4 is put in at 404 on SPY. So the most conservative thing that we can expect right now is that 404 holds as the low, and the volatility index doesn't break above 27.41, then we're going to see SPY go the length of wave 1, placed at the wave 4 low. That conservatively will take it to 430. Now, I think that's conservative, and I'm going to explain why that's conservative when we talk about QQQ, Microsoft, and Amazon. So let's just look at this Amazon count real quick before we get into Microsoft and QQQ. So Amazon pretty clearly completes a 1, 2, 3, 4, 5 large degree wave 1 impulse. It's now completing an ABC correction at exactly the 61.8% retracement of wave 1. So there's very clear levels for this count right now for Amazon. Ideally, a 61.8% retracement will cap a wave 2. You probably don't want to see a wave 2 go below the 78.6% retracement of wave 1. So that's where we get our stop level. Amazon, I want to see you above 3,025. So if Amazon is above 3,025, that's the stop. The invalidation level is all the way down here at 2,881. Why is that the invalidation level? Because that is the beginning of wave 1. So the low of wave 1 is the invalidation. Amazon goes on a 1, 2, 3, 4, 5 large degree wave 1. It's important to realize for Amazon that this whole move from 3.5 to 430 is all a wave 1. We're going to talk about that fact with QQQ in a second, but just think about this. So if this is a wave 2 low being put in, then the conservative Amazon target says that in about 2.5, 3 months, we're going to see Amazon at 3,800, and that actually should be conservative. Okay, because wave 3 is stronger and faster than wave 1 in Elliott wave theory. So in the next 2.5, 3 months, we see Amazon have this wave 2 low be put in. We're going to see Amazon at 3,800. Okay, and right then and there, that's when you kind of have to look at SPY and say, is it really making sense that SPY is going to stop on a dime at 430 and Amazon's going to be at 3,800? That's why I'm starting to kind of prep for the idea that this sell-off that we got in early May may be a bigger low being put in than a lot of us realize right now. So let's talk about the Nasdaq right now. I want to emphasize something very clearly. Well, first, let's just get into the count. So this is a wave 1 and a wave 2, then a wave 3, and an ABC correction puts in a wave 4 low. So from here, by this count, we're beginning a larger degree wave 5. So what we had was that this was wave 1 of wave 5, this was wave 2 of wave 5, and then wave 3 of wave 5 passed the 161.8% extension of wave 1. So what did we have for Amazon, for the Nasdaq? What we did have was that if 324 was not broken, because that was the wave 1 high, and it was the 50% retracement of wave 3, then we were expecting that the Nasdaq would go the length of wave 1, place at the wave 4 low, and then it would be due for a correction. Okay, so what happened? Well, we broke below 324. So why do I have a 3 on this chart and why do I have a 4? The answer is very clear because it's conservative. I want to keep the conservative view alive for the Nasdaq right now. Here's why. Really, this is a 61.8% retracement of a prior impulsive wave. So what should that actually be? That actually should be another wave 1 and another wave 2. Okay? So if that was actually a wave 1 and a wave 2, then the length of wave 1 placed at the wave 2 low, so long as 316 was not broken, would take QQQ to 351. Very aggressively, that would happen in 4 weeks. I think 6 weeks is a more, kind of idealistic target, and 8 weeks would be, more conservative. We'll talk about with Amazon, Google, how that, really lines up, as well as Microsoft. But if this is a 61.8% retracement for the Nasdaq of a prior impulse structure, then this should really be another wave 1 and another wave 2. The reason that I want to keep the conservative view alive is because I want to make sure that we remember that when QQQ's at 351, that we're, reevaluating and taking caution. I have no problem readjusting the count to the more aggressive view when we get here. I would rather adjust from conservative to aggressive than from aggressive to conservative. So why is this the conservative view? Why do I want to keep these 3s and 4s on the chart? Well, in Elliott wave theory, wave 5 will either be the length of wave 1 or it will be the length of wave 3. So in orange right here, I'm showing that if wave 5 were the length of wave 1 placed at the wave 4 low, the Nasdaq would not break above 342. If wave 5 were the length of wave 3 in purple, the Nasdaq QQ would go all the way to 351. Okay, and that's all if 316 wasn't broken. So the reason that I'm keeping this as a wave 4 low, even though it's below the wave 1 high, and even though it's past the 50% retracement of the prior impulse, is to have the conservative view still be alive. I know that this more likely is another wave 1 and another wave 2. Okay? I want to keep the conservative count alive, and if I need to readjust in the 350s, I will. Okay, but for now, the projection is that if 316 is not broken, and around the next 6 weeks, we're going to see QQQ go all the way to 351. So, puppy trades, what if 316 is broken? Well, what's the evidence 316 won't be broken? First is that SPY really appears like it put in a wave 4 low at 404, and it really appears like the VIX, the volatility index, put in a V top around 27.41, as well as the fact that Amazon looks ready to blow up, and honestly, so does Microsoft. But we'll get into Microsoft in a second. Would it be the end of the world for the Nasdaq to break below 316? No. Okay, what could it look like if the Nasdaq broke below 316? And this is not what I'm projecting will happen. Okay, I just want to explain why. If 316 was broken, it wouldn't be the end of the world. So, what if 316 was broken? Well, I would expect the Nasdaq QQQ would look almost identical to Amazon. So notice how with Amazon, this is the 3-5 low. It goes on a 1, 2, 3, 4, 5 waves impulse and puts in a high in late April. So that's exactly what Amazon does, right? This is all wave 1, and then a wave 2 correction is put in at the 61.8% retracement. So if, hypothetically, the Nasdaq broke below 316, this would very clearly be a much more bullish count than I have presented to date. Okay, what this would look like, and remember the primary projection is based on 316 not being broken. But in a hypothetical situation where 316 is broken, would we be looking for Armageddon yet? No. If, hypothetically, this low of 316 was broken, I believe that the Nasdaq would begin forming a huge wave 1, and this ABC correction would put in a wave 2 low between the 61.8 and 78.6% retracement box. And then there would be no other way to count this, where this is all a wave 1, and then placed at the wave 2 low, would give a conservative wave 3 target of well above the 350s. So my primary count is based on 316 not being broken. If 316 is not broken, the conservative view is in the next, about 6 weeks, ideally we'll reach about 352. It's also important to realize that in the back of my mind, I've already begun adjusting it from the more conservative view, which is that, to the more aggressive view, which says 351, 352 won't be the top, and that this sell-off that we're getting in the market is actually something much bigger than a lot of us are expecting. So let's talk about Microsoft and kind of reiterate that point. What do I mean when I say calling this a wave 3 and a wave 4 is conservative? Well, I think Microsoft answers that the best. So we actually predicted this whole move in Microsoft before it happened, that if this low of 224 was not broken, the length of wave 1 placed at the wave 2 low, and time and price would give a conservative target. Now, we were expecting that this would be a wave 3 being complete. So what's the first kind of bit of evidence that Microsoft hasn't completed a wave 3? Well, it didn't reach the 161.8% extension of wave 1. That's kind of the first red flag of calling this a wave 3. Okay, what's the other view of why this might not be a wave 3 high being put in? It's the same thing as the Nasdaq, where we've gone deeper than the 50% retracement of the prior impulse, and we've broken the wave 1 high. So, puppy trades, why do you want to keep this wave 3 and wave 4 on the chart? The reason is to be conservative. If I call this a wave 4, then we're looking to take caution when the length of wave 1 placed at the wave 4 low is reached for wave 5, which is 272. That would happen in about the next 6 to 8 weeks. Okay, and that's ultimately why I want to keep these 3s and 4s on the chart, so I remember to take caution when the length of wave 1 placed at the wave 4 low is reached, which would be 272. I have no problem adjusting in the future to the more aggressive bullish count. Okay, what's the more aggressive bullish count for Microsoft? Well, this is a wave 1, this is a wave 2. Wave 3 doesn't reach the 161.8% extension, and wave 4 goes past the 50% retracement of the prior impulse, and it breaks the wave 1 high. So this more likely is a nest, right? And then this is the problem with being bearish Tesla right now, is there's a lot of evidence that Microsoft is nesting. There's a lot of evidence that Amazon is ready to blast off, right? So let's just finish Microsoft real quick. I think the most conservative view, we'll keep this more bullish count in our back pocket. But I want to take the more conservative view that we're completing a wave 3, a wave 4 corrections being put in, and then the length of wave 1 placed at the wave 4 low will take Microsoft to 272. Right now, in the very short term, I don't want to see this low of 238 broken. I would consider the more invalidation level to be the 78.6% retracement, which is 232. Okay, let's get into another tech stock. This is Google. So I think Google's count is very clean. Okay, and is lining up with a lot of the time projections that we're seeing for the rest of big tech. We have a wave 1 and a wave 2. And then wave 3 passes the 161.8% extension of wave 1. Then we have an ABC correction putting in a wave 4 low at exactly the 23.6 to 38.2% retracement of wave 3. So this is a textbook 1, 2, 3, 4, 5. What I love about this count is that the wave 1 high is basically exactly the 38.2% retracement of wave 3. So we don't want to see 21.45 to 21.49 broken. If that's not broken, the length of wave 1 placed at the wave 4 low will take Google to about 2,648. That's going to be in the next 6, 7, 8 weeks, lining up with what we're seeing in Amazon, Microsoft, and the Nasdaq. Okay, let's talk about Apple real quick. So Apple is very similar to QQQ. Puppy trades, why do you have a wave 3 and a wave 4 on this chart if wave 4 has passed the 50% retracement of the prior impulse and it's broken the wave 1 high? The answer is to be conservative, okay? So let's just talk about those wave theory principles again. Wave 5 is either going to be the length of wave 1 or it's going to be the length of wave 3. So how I have this counted now is that if Apple went the length of wave 1, placed at the wave 4 low, it wouldn't break to a new all-time high. Or it wouldn't break to a new high above this wave 3 high. So it couldn't be a wave 5, right? Wave 5 can't end right here. Wave 5 has to break above the wave 3 high. So if wave 5 isn't the length of wave 1, then it would be the length of wave 3 placed at the wave 4 low. So just like Microsoft and just like QQQ, why do I want to keep these 1, 2, 3, and 4 numbers on the chart if I know from a more technical perspective, it should probably look like this is a nest, where this is another wave 1, and this is another wave 2 low being put in, because I have no problem readjusting to the more aggressive count in the future. I have no problem readjusting Apple to a more aggressive count if we break above 140. Okay, I would rather readjust from conservative to aggressive than from aggressive to conservative. So in this view of a 1-2, 1-2, the length of wave 1 placed at the wave 2 low would take Apple conservatively to 140. This move is from 330 to 429. 4, 6, 8 weeks from now, just like Google, just like Microsoft, just like the Nasdaq, I think Apple's going to go to 140. Right now, the very clear level is 122, right? If 122 is not broken, Apple should be a leader in this market. Now, what if 122 was broken? What would that look like? Well, first, let's just continue to make sure we wrap up what the projection will be if Apple doesn't break below 122. If Apple doesn't break below 122, then the reason I'm keeping this as a wave 3 and a wave 4 is because the length of wave 3 placed at the wave 4 low would be the wave 5 target, and that would be conservative. When Apple gets to 140, we would know to start being cautious, okay? I'd rather readjust from conservative to aggressive than vice versa, okay? So for now, if Apple's above 122, I don't want to see, then I expect in the next 4, 6, 8 weeks, we're going to see Apple reach 140. Now, what would happen hypothetically, like QQQ, if that low was broken? Now, I don't think the bet to be making is that Apple will break to a new low. But what would happen? Well, we would just be looking for a slightly deeper wave 1 and a wave 2 correction. So let's say hypothetically that 122 was broken. The next step would be that we are looking for some type of Amazon action where this 1, 2, 3, 4, 5 waves impulse is all one big wave 1. I think it would be the same thing for Apple if we saw a new low be made, that this was all a wave 1, and then this is a wave 2 being put in between the 61.8 and the 78.6% retracement of wave 1. But I want to keep the conservative count alive. If we don't break below 122 for Apple, if we don't break below 316 for QQQ, then we're going to see QQQ reach 351 in about the next 6 weeks, and Apple at that time would be going to 140. This sort of alternate count, if the 122 was broken, would be very pretty for Apple. It'd be a very clear setup where this would be a wave 1, a wave 2 low would be being put in. The length of wave 1 placed at the wave 2 low would be a very conservative target for Apple, and that's only if 122 was broken. So let's talk about some other sides of this market. Here's NIO. So NIO did break below this low right here of 31. So I said in my prior video, it wasn't going to be freak out time if NIO broke below 31, because I was still going to be looking for a wave 2 to end at the 61.8% retracement of wave 1. So that NIO is still in this box right now. I believe this is a wave 1, and ABC correction is putting in a wave 2 low. I think in the next 8 to 10 months, we're going to see NIO, as long as the 61.8% retracement of 26.57 is not broken, NIO is going to go the length of wave 1, placed at the wave 2 low. It's going to reach 94, 97 in 8 to 10 months. Okay, and that sounds crazy to a lot of people. It's just the length of this move placed at this low, but I do believe NIO is in between the 50% and the 61.8% retracement of wave 1. There's a very clear invalidation right now of 26.57. I don't want to see 26.57 broken, and if it doesn't, then NIO is going to have an impulsive wave 2 rally from this box, and it is going to go all the way to 97. I think that's going to happen in the next 8 to 10 months. I think we're going to wake up in January with NIO in the 90s, as crazy as that sounds. So let's talk about Tesla, right? We can't talk about NIO and Apple without talking about Tesla. Where does Tesla fit into all of this? Well, we just talked about QQQ going to the 350s being conservative, and Microsoft, going to the 270s being conservative, and Amazon going to the 3,800s being conservative. So what's Tesla going to do in this type of scenario? Well, everyone's bearish Tesla. People think shorting Tesla is a good idea, and their downside target is about 200 points lower than it is currently, okay? I don't think that's the bet to be making. Right now, the next invalidation level for Tesla is going to be all the way down at 539. So the bears think that Tesla goes on an impulse down, and then this was the counter trend rally, and then they're just going to have a free ride shorting Tesla down to 420, right? And we just talked about Microsoft, the Nasdaq, Amazon and Google, how they look like they're ready to take a big leg higher. So I think NIO and Tesla are going to surprise a lot of investors. 539 is the next level that bulls have to defend, okay? I need to see Tesla react impulsively from this box. If we got Tesla above 631, I think this would become a more high probability setup. Right now, 539, if the bears break that, then they're expecting that they're going to go the length of wave, what they're calling wave A, place at the wave B high, all the way down to 424 for wave C. Right now, this is the wave 1, potentially an ABC correction, wave 2 low being put in. I don't think the bulls have lost yet. And I think if you look at the Nasdaq, if you look at Microsoft, if you look at NIO, and we'll talk about other growth stocks in this market, what it very well could be is that this big, money outflow that we got today potentially was a large rotation in the growth stocks. I'll explain that later in this video. So let's talk about some industrial stocks. This is American Airlines. So American Airlines is really a big piece of evidence that the market isn't ready to be done in the short term. This is a wave 1. An ABC correction puts in a wave 2 low. The 161.8% extension of wave 1 would take American Airlines all the way to 31. Okay, this is a 2-month run. And if we see this low, well, really, I want to see this high of 18.63 not be broken. I don't think it will, but if this low holds in the very short term, which is 19.64, I think this 2-month rally will be replicated. In the next 2 months, we're going to see American Airlines with Boeing go all the way to 31.79, and then that wouldn't be the top. We'd have a shallow wave 4 correction between 23 and 26 before a 5th wave higher. So Boeing, very similar in that regard of evidence is why the market probably isn't done in the short term. Boeing had a wave 1 and then an ABC correction put in a wave 2 low, then had another wave 1 and another wave 2. So right now it's broken and closed above both of these wave 1 highs. That's a lot of evidence that Boeing's nest is incomplete to the upside. A nest is a 1-2, 1-2 in Elliott wave theory. It's the alternate count we have for Microsoft right now, where Microsoft could be nesting, and that's why we want to keep the conservative view as our primary, but we're going to have this more aggressive 1-2, 1-2 in our back pocket. Boeing's a very good example of that. This is a wave 1, an ABC correction puts in a wave 2 low. This is another wave 1 and another wave 2. I think Boeing is going to go to the 161.8% extension of wave 1 and reach 307. Right now, I think 210, the 78.6% retracement of the prior impulse, is the most logical stop loss. The invalidation level is 191. We had a big move today, 5% moves in United Airlines, Delta Airlines, and American Airlines to end the week. 7 to 8% moves in Royal Caribbean, Norwegian Cruise Lines, and Carnival Cruise Lines to end this week. I think that's going to be a larger trend in the coming weeks. In the next month and a half. I think the most dangerous thing for an investor hypothetically to do is ignore industrials at this phase. But right now, I think that we're going to see, likely towards the end of June, but really in the next 2 months with American Airlines, 2.5 months, we're going to see Boeing go on this wave 3 thrust, and it's going to reach 307. The most reasonable invalidation level right now is a 78.6% retracement of 210. And this low of 191. So Boeing, American Airlines, they're taking moves higher. Let's talk about some growth stocks real quick. This is Fastly. So what could this be? What could this week's sell-off have been in the bigger term view? What it could have been in the bigger term view is that this big correction, it wasn't big, but it felt like it was big in the, when you were going through it, was a huge rotation into the growth stocks. I think Fastly and NIO are good examples of that, where NIO is between the 61.8 and the 50% retracement of wave 1. I'm looking for NIO to hold above 26.57 and begin wave 2 higher. And I think that's also a lot of evidence that it doesn't really make sense to talk about Tesla in the 424s. So we'll see. The bears really think they've got Tesla going down to 420. Let's make sure that 539 is broken first before we do that, bears. Because if it looks like the Nasdaq, Google, and Microsoft and Amazon are taking a big leg higher, what this could have been is a big rotation into some of these growth names. I think NIO is a good example of that. I think Fastly is a good example of that. So Fastly goes on a 1, 2, 3, 4, 5 large degree wave 1 impulse. An ABC correction looks like it's putting in a wave 2 low where the length of wave C has reached the length of wave A right between the 61.8 and 78.6% retracement of wave 1. I'm not interested in Fastly personally as an options trader. I am interested in it as a long-term shareholder. Right now, the only reasonable stop is 37.57 because that's the 78.6% retracement of wave 1. Now, if an investor hypothetically, right, because this is an investment advice, if an investor hypothetically enters Fastly with a 4 or 5% stop loss, what are the likelihoods that they're going to wake up in 2023 with shares of Fastly? Very slim. Okay, very slim. Growth stock investing. For me, I found that position sizing, time horizon, and diversification are where you're going to get, the best forms of risk management. Entering Fastly with a 5% stop, you're just not going to wake up in 2023 with Fastly. So why bother? Okay, but this is a 1, 2, 3, 4, 5 large degree wave 1. An A, B, C correction puts in a large degree wave 2. Most reasonable stop right now is 37.57. because this is a 78.6% retracement of wave 1, but the length of wave 1 placed at wave 2 would take Fastly, as crazy as it sounds, all the way to 165. Okay, now I need to see this wave 2 low be put in before I give a time target. But once this wave 2 low is in, this is from 316 to 1012. That's about a 7-8 month run, and it's lining up with what we're seeing in a lot of these growth stocks. I think the boldest thing to do right now is ask yourself, did we just rotate into growth, right? The most dangerous thing you can do is assume that and ignore Boeing, American Airlines, and these oil stocks. But the aggressive thing that I think a lot of traders have to ask themselves, was this the week, 2 20% VIX spikes in a row, that we finally rotated into growth? I think NIO supports that argument. I think Fastly supports that argument. And if NIO and Fastly are supporting that argument, these bears, the most popular trade right now on FinTwit is shorting Tesla to 422. I mean, forget wave theory. That's all you need. They think they're going to short Tesla 150 points lower. We'll see. I know how this story goes. FinTwit wants to short Tesla 150, $180 lower than its current price. We'll see. We'll see how that goes. But anyway, Fastly, 1, 2, 3, 4, 5, large degree wave 1. An A, B, C correction, the length of wave C has reached the length of wave A. Only reasonable stop is 37.57. The length of wave 1 placed at the wave 2 low. That could take Fastly to 165. We need to see this wave low put in. I honestly want to see a reaction from this box before I give a time target. But it would be about 8 months, 7 months from this wave 2 low being put in. That's lining up with what we're seeing in NIO. Okay, what's another growth stock supporting a similar thesis? Now, the time target for this one is tricky, but we've talked about, Amazon and how it is expected to go to 3,800 for a conservative wave 3 target. Remember, wave 3 is actually larger than the length of wave 1, and that would only be wave 3. We didn't be expecting a shallow wave 4 correction before a 5th wave higher. So, this is Alibaba. I think this is really interesting right here, that this is a large degree wave 1 and a large degree wave 2. And then we have a 1, 2, 3, 4, 5 putting in another large degree wave 1. Now we're having an A, B, C correction. Most retail traders have been worn out of Alibaba, maybe rightfully so, right? But the breaking of this low, that took out just about every retail trader's stop. If we look at Amazon and we look at some of these other big box retailers like Walmart, and maybe some of more of the stay-at-home side of the market, I think Alibaba is another growth stock that is entering a buy zone, okay? This is a wave 1. This is a wave 2. Another 1, 2, 3, 4, 5 puts in another large degree wave 1, and ABC correction puts in another large degree wave 2. So the time target right now, this is going to be an eye roll, right? This is from 5/27 of 2019 to 10/26 of 2020, like almost a year and a half. Okay, remember in Elliott wave three is much stronger and faster than wave 1. Regardless, I'm not really interested in putting a 2-year time target on Alibaba. I think this is something to watch, though, that it's going to have a impulsive reaction at the 61.8 to 78.6% retracement of wave 1. To me, the risk reward is phenomenal. The 78.6% retracement of 184 is the most reasonable stop level right now. If that holds, the length of wave 1, place of the wave 2 low would take Alibaba all the way to 378. Now, time targets are tricky because this is a wave 1, and wave 3 is stronger and faster than wave 1. I think that a year and a half from now, aggressively, in about 10 months, we're going to see the length of this entire move be replicated on Alibaba. And as long as 184 is not broken, my next target for Alibaba is 378. So Alibaba, to me, is another growth stock like Fastly, like NEO, that is really kind of giving signs that we're going to rotate into growth if we didn't do it this week. So let's get some more charts out of the way. This is XLE, the oil stocks. I think this is a really good evidence that the market hasn't topped in the short term. Wave 1, an ABC correction puts in a wave 2 low. Then we have a 1, 2, 3, 4, 5 waves impulse that we're looking to complete a larger degree wave 3. So wave 3 and Elliott wave 3 is the 161.8% extension of wave 1. That would take XLE all the way to 61. And this wave 3 is beautifully subdivided into 5 waves. 1, 2, 3, 4, and then we broke above the wave 3 high today of this smaller degree subdivision of this larger degree wave 3. So very clear target. The length of wave 1 placed at the wave 4 low would take a smaller degree wave 5 to 61. That's also the textbook larger degree wave 3, which would be the 161.8% extension of wave 1, which is also 61. So to me, 61 is a magnet right here. 61 is a magnet. XLE might not be the best entry now, but it gives a really good gauge for the stock market that if this wave 4 low of 46.25 holds, we're expecting XLE pretty conservatively to march on up to 61. I think that's very bullish for Boeing, and I think that's very bullish for American Airlines as evidence that the industrials are going to continue their rally higher. What's another oil stock? We've talked about this one a lot. This is Chevron. So Chevron completes a wave 1, a wave 2, and then puts in another. I believe this is the larger degree right now, that this is the wave 1. So the 161.8% extension of wave 1 is your typical wave 3 target. That would take Chevron all the way to 135. Okay, I don't even think that needs to be the target right now because this is a beautiful count for this subdivision. That this large wave 3 is subdivided very cleanly into a 1, 2, 3, 4, 5 waves impulse. And I think Chevron might start playing catch up in this oil sector. So XLE, remember, has already broken above this high of wave 3. I think what this really is for Chevron is that this large degree wave 3 is very cleanly subdivided into a 1, 2, 3, 4, 5 waves impulse. The length of wave 1 placed at the wave 4 low would take Chevron all the way to 130. That would be just slightly below the 161.8% extension, which would be the larger degree wave 3 target of 135. So this is from 10/29 to 11/24. That's about 4 weeks. I think just like Boeing, just like American Airlines, 2 months, 2.5 months conservatively from now, if Chevron doesn't break below 99, then this wave 4 is in, and we're going to see Chevron go on a big rally higher with the industrials and reach 130. So that's XLE, Chevron, Nike. I'll just go over real quick. We talked about Nike a lot, but this is really looking good. A wave 1, a wave 2, wave 3 passes the 161.8% extension of wave 1. The wave 4 low of 125 is basically exactly the 38.2% retracement. The length of wave 1 placed at the wave 4 low takes Nike all the way to 169 for wave 5. This rally is from 316 to 601. So less than 3 months. I think, 3-4 months from now, we will see Nike reach 169. If you think Nike's going to reach 169, it's another one where you look at SPY and you're like, okay, will SPY actually stop at 430 on a dime? What I'm trying to say is I think this correction is a bigger low than what we're expecting right now. And I think the bold thing to do is ask if this correction was the rotation into growth. But the dumbest thing to do is assume that it wasn't and have these industrial stocks continue to just explode higher. And what's evidence that these industrial stocks will continue to explode higher? Remember, I love this screener right here. This is the long straddle and the long strangle screener. We'll talk about these real quick. I'll do Disney. We'll wrap up the video. But this is the long straddle screener. So rules for this screener. First, ignore unusually high probabilities, okay? Especially at the end of the week. They'll talk about these 99%, chance probabilities. And ignore those, okay? Ignore these. Look in the meat of this screener, okay? The meat of this screener. For the straddle screener, you're going to see stocks in the 60s. For the strangle screener, you're going to see stocks with the 50% probabilities, okay? The probability is not as important to me, but let's just go over the filters. First filter, ignore unusually high probabilities at the very top of the list. Second filter, ignore any stock that is below $10 or $15. Third filter, make sure the stock has been trading options for longer than 1 year. Okay, and that's just that should go without question, right? You should not even have to think about whether or not the stock has had options trading for longer than a year, right? So if you look at Boeing, United Airlines, American Airlines, you don't even have to ask if those stocks have had options trading for longer than a year. So here's how I like to use this screener. If a stock in a sector shows up on this screener with other stocks in the same sector and they stay on that screener for a while, there's a high likelihood that these stocks are going to be the next in the rotation in the short term. And I'm going to prove that in a second, but let's just look at what that would kind of tell you looking at the screener right now. Okay, Rocket Mortgage, CCIV, they haven't had options trading for longer than a year. They're disqualified. These 5 up here, 99%, unusually high probability. Focus on stocks that appear in the same sector as other stocks with prices in the above 20, I would say, right? So let's look. American Airlines, Boeing, Norwegian Cruise Lines, United Airlines, American Airlines, United Airlines, Boeing. Okay, that's a pretty clear pattern of airlines and cruise lines. The options market is telling you right now they are going to have a big move. Okay, and I'll show some data in a second. But this is the long strangle screener. Let's see what it says, right? And this is why I think it's very ignorant right now to ignore industrials and to ignore oil in the very short term. Okay, let's look at the strangle screener. Very similar story. Boeing, Carnival Cruise Lines, United Airlines, Norwegian Cruise Lines, American Airlines, Boeing, United Airlines, American Airlines, Carnival Cruise Lines. Sounds like the options market is pretty damn positive that the cruise lines and the airlines are going to take a big move. So what do I mean? Is this a magic screener? Puppy trades? Are you trying to, no, this is just the screener, right? This is only a tool. But here's a picture of this screener from January 21st. I think this is a really good idea of kind of showing what we're looking for when we look at the screener of stocks that are showing up in the exact same sector, right? This is from January 21st. Boeing, Norwegian Cruise Lines, Delta Airlines, and right, so all these airlines and all these cruise lines are showing up together in the travel and leisure sector. What's more important to notice is that this picture is from January 21st, and look at this clear pattern. JP Morgan, Citibank, JP Morgan, Wells Fargo, Citibank, Bank of America, JP Morgan. All right, Morgan Stanley. Sounds like a pretty clear theme that the financials were ready for a big move higher, and we know how that played out, okay? This isn't the first time I've used the screener. Any trader, hypothetically, who made money on American Express, I pulled American Express right off of this screener, okay? I said that American Express was going to go to 100 and 149. I pulled this right off of the screener, and I tweeted about it as well. So remember, American Express was all over the screener. Let's also look at the screener. This tweet was from January 19th. Home Depot and Lowe's and Home Depot were all over the screener. So I didn't post, as projections about any of these because they didn't do exactly what I thought they would. But American Express did reach my target. I pulled it straight off the straddle screener because it had shown up with a bunch of banks like Bank of America, Raytheon. This is another one. I pulled straight off of the straddle and strangle screener. It didn't reach my time or my price target, but it did do very well, and I pulled it straight off of the screener. I don't post about anything unless it does exactly what I say. So Raytheon did do very well, but I'm just trying to show this because I got Raytheon right off of the straddle and strangle screener. Kraft Heinz Foods, KHC actually is doing exactly what I said it would. I pulled this one straight off of the bar chart, straddle and strangle screener. All of these are from mid-January. My best projections from mid-January came straight off of the screener. Here's Home Depot, right? Home Depot and Lowe's were all over the screener, and that's where I came out with my projection for Home Depot way back in December when it was at 260, that it was going to go on a big rally to what sounded crazy, what ended up being a little crazy. It didn't reach 413, but it did go on a huge rally higher. All I'm trying to show with these is that they were all pulled directly off of the bar chart, straddle and strangle screener. United Airlines was another one I posted about. This did pretty much exactly what I said. United Airlines and American Airlines, they were all over the straddle and strangle screener with the travel and leisure stocks. I pulled these straight off. American Airlines, I said, was nearly identical, was going to 25. And then NCLH was another one that I literally pulled right off of the straddle and strangle screener. Carnival Cruise Lines, which did exactly what I said it was. Speaking of Carnival Cruise Lines, remember, it is on this screener right now. Carnival Cruise Lines is all over the screener, and it had a huge move today. Carnival Cruise Lines and Norwegian Cruise Lines both up 8%. This is one to watch. I posted about this one a little bit, but this weekly chart looks really pretty. A wave 1, an ABC correction puts in a wave 2 low. The 161.8% extension of wave 1. We go on a wave 3 rally, which is also the bull flag equal legs target of 36. Same thing as American Airlines, same thing as Boeing. I think in the next 2.5 months, we will see Carnival Cruise Lines at 36. That wouldn't be the top either. We'd be taking a 5th leg higher. So I hope I've made the case. The bold thing to do is to say, did we just rotate into tech and growth? And there's a lot of evidence for that with Microsoft, QQQ, I think NEO and Alibaba as well are evidence that we could have just rotated into big tech and growth. If we look at the bar chart, straddle and strangle screener, there's also a lot of evidence that in the very short term, ignoring the airlines and ignoring the cruise lines could bite a trader, hypothetically, in the ass. Okay, one last stock that kind of fits in with that narrative for the reopening plays. I think Disney is finally ready to post about. So Disney, to me, this count is very clear in validation levels. It reminds me a lot of Nike, actually. A wave 1, a wave 2, a wave 3 that blows past the 161.8% extender 80. So I think a really tight stop would be the 38.2% retracement, which is 166. But if that is not broken, then I expect Disney, with the rest of these reopenings in wave 5, the invalidation level would be the 50% retracement, which is 155. The most reasonable stop is the 38.2% retracement of 166. If that's not broken, the length of wave 1 from 3.2 to 601, I mean, this is almost identical to Nike, right? We're about 3-4 months from now, Disney's going to go on a wave 5 higher, and it's going to reach 218.